Hello, everyone. Over the past several weeks, Datavault AI, traded under the ticker Dvlt, has once again captured the attention of investors after a rough and unpredictable ride in its stock performance. The company has already been on a chaotic track this year, but the latest fluctuation has sparked a fresh wave of curiosity about its long-term trajectory and whether the market is correctly pricing its potential. The recent price action tells a dramatic story. After a massive rally earlier in the year, the stock suddenly cooled off, losing close to 20% in the past month alone. Despite this pullback, the momentum is still significantly healthier compared to the previous quarter. In fact, investors who have been patient enough to hold DVLT for the past year have finally enjoyed a respectable return of nearly 30%. This is notable because the stock had struggled for quite some time before this recovery began. This kind of short-term volatility often signals shifts in investor psychology. It could mean the market is trying to reassess the company's growth runway, or it could simply reflect broader uncertainty about high-risk, high-innovation sectors. Datavault's recent rebound from earlier lows has put it back on traders' radar, and now everyone is trying to figure out whether the stock is still undervalued, or if the latest surge already captured most of the upside. Right now, Datavault AI is trading around $2.13, while many popular valuation models place its fair value much higher, roughly at $3. This wide deviation between what the stock is and what many believe it should be has created a heated discussion. Some believe the stock is a hidden gem still waiting to be recognized by the broader market. Others argue that the optimism embedded in these models is simply too ambitious, especially for a company still proving itself in a competitive industry. A major reason behind the bullish outlook is the company's increasingly strong partnership with IBM. Achieving platinum partner status and integrating IBM's Watsonx.ai technology is a huge strategic win for Datavault. With this alliance, the company gains deeper access to enterprise-grade AI tools, advanced cybersecurity frameworks, and the credibility that comes from aligning with one of the biggest names in technology. This could dramatically improve Datavault's ability to scale its services while keeping operating costs in check. Over time, that kind of efficiency often translates into stronger margins and a more stable financial foundation. But what exactly is fueling the aggressive price targets floating around? Analysts and bullish investors are betting on high double-digit revenue expansion, significant improvements in profitability, and a valuation multiple that reflects a maturing, fast-growing AI ecosystem. These expectations assume that Datavault will not only maintain its growth pace, but accelerate it, driven by enterprise adoption and the strength of its partnerships. However, the story isn't without risk. Datavault AI depends heavily on revenue that hasn't yet been recognized, which introduces uncertainty around near-term earnings. On top of that, the company's active acquisition strategy, while promising, also carries its own complications. Rapid acquisitions can create integration challenges, unexpected costs, and short-term pressure on financial statements. These factors could easily contribute to earnings swings that worry more cautious investors. So the big question is this: is Datavault AI still an undervalued opportunity that the market hasn't fully appreciated yet? Or does the recent volatility indicate that expectations have gotten ahead of reality? As the company continues navigating strategic partnerships, scaling AI offerings, and expanding its revenue base, the market will eventually reveal whether Dvlt is a rising star or simply another high-risk tech stock facing big promises and bigger challenges. This is not financial advice.